In this video, we're going to be talking a little bit about health insurance and how it works. Now, our focus really is going to be on kind of the general concept of health insurance. And so know that there are going to be differences with regards to health insurance depending upon the type of plan you have and depending upon the type of health insurance coverage you have, whether it's more of a managed plan through an employer, maybe it's a plan that you purchased on kind of an open market, and you are sort of self-insured, or you're insured through maybe a government program like a Medicare or a Medicaid. So we're talking about the general idea of health insurance here. So for this to work, we have two parties, right? This is kind of a basic concept of markets where you have mutual beneficial exchanges between two parties. So on one hand, we have the insured. The insured is interested in healthcare coverage. On the other hand, we have an insurer. An insurer is a big company that provides access to healthcare insurance or helps to subsidize the risk to an extent. And so they're interested in premiums. They have shareholders typically, although not always. So the way this arrangement is going to work is the insured is going to commit to make some kind of monthly premium payment. And in return, the insurer is going to agree to certain coverage within policy limits. Now, every health insurance policy has certain terms and conditions, which of course you'd want to read up on to make sure what is covered and what isn't. But this is the basic idea of the relationship. The purpose of doing all of this is twofold, at least from the perspective of the insured. The first thing is we have what we call risk transfer. So by purchasing health insurance or having access to health insurance, what this allows us to do is take the risk of becoming injured or becoming ill and ultimately transferring it to another party. So instead of paying the full cost of an emergency room visit, we're transferring the risk to the insurer, which thus limits our risk, right? The only way to avoid risk entirely is probably not to do anything. So because the things that we do during the day, whether it's going to work and driving in a car and other things, we incur some element of risk. We're inherently transferring that risk to the insurer. The other thing that we do here is we also engage in risk reduction. We engage in risk reduction because in the event that something does take place, the cost to us is minimized because we have health insurance coverage. And so we will pay a certain amount, but our policy limit also allows us to have additional coverage beyond a certain point. Now, the other element here with regards to coverages has to do with what we call deductibles. So every health insurance policy, much like your auto insurance, has a deductible. This deductible represents the initial amount of money that you're responsible for. Let's say if you were to go to the ER and your ER deductible is $1,000. And let's just say by chance that the ER visit comes out to $300. Well, your deductible in this case is $1,000. So the amount of the expense has to actually exceed that before it kicks in. So in this case, you'd be responsible for the $300 ER visit, depending upon how much other coverage you've used over the course of the year. Now, in another example, let's say you still have a $1,000 deductible, but your ER visit is $1,300. Well, in this case, your policy is going to cover the $300, and you have that $1,000 deductible. Now, many policies contain a deductible per person and then also per family. And so what you need to be able to do is you need to exceed your deductible first before the health insurance coverage begins to kick in. The good thing about this is not per occurrence typically. This is usually over the course of a given calendar year. So chances are by going to the doctor several times, you're going to exceed your deductible at some point, unless you have a very high deductible, in which case you're not paying a great deal in insurance for that particular coverage. That's kind of the trade-off. Now, the other element here that many insurance coverages offer, another component to that, is what we call a copay. Now, copay is essentially that initial amount of money that you pay for a visit. And this is what we call your out-of-pocket. So many standard office visits come with a copay. Your copay might be, let's say, $20. It might be $50. And so every time you go to see your primary care physician, you're going to pay $20 to $50, depending upon ultimately what your coverage entails. That's just simply out of pocket. Now, the other element is what we call coinsurance. Now, this is how the the coverage or what you go and seek treatment for, how it's divided up. As an example, coinsurance might be 80-20. What this typically means is that 80% of what is considered to be reasonable is covered by the insurer. And then 20% is covered by the insured. So it's a way to sort of have an element of shared responsibility so that the insurance company isn't covering everything, and there's a little bit of responsibility on the insured, who is of course seeking treatment. Now, some policies have completely 100% coinsurance, or 0% rather, which means that the insurance company is going to cover everything, and you're not going to get a bill in the mail. Now, going back to kind of the coverage aspect of it, there's an important component in every insurance policy, which is known as UCR, which stands for usual, customary, and reasonable. And so this is an amount of money that is per procedure that is dictated by the insurance company. And so what they do is kind of a market survey to determine how much things cost in a given area, and they have agreed upon limits for how much they'll pay for. So as an example, if your insurance, you go to the doctor and you have a bill for $150 for a procedure, and your coinsurance is actually $100, or your UCR for that procedure is $100, well, then the insurance company is going to pay the $100. The primary care physician then essentially just discounts their cost from $150 to $100. That typically is not something that you are responsible for, and that's based upon an agreement between the insurance company and your primary care physician. So that's a little bit about how UCR reductions work. And if you look at the explanation of benefits that you often receive in the mail, you'll be able to see what the billed amount was by your primary care physician, and then ultimately what the UCR adjusted amount was, which was the amount the health insurance company agreed to pay. The great thing is that your coinsurance is based upon this amount. So it's not based upon the inflated amount that the doctor is billing for, but it's based upon the UCR adjusted amount, which of course means that you're going to spend less money out of pocket. Now, ultimately, there are different types of health insurance coverage. There are different levels of insurance coverage. And so those levels typically have an effect on a couple of things. Depending upon how much you pay for, it will affect your copay and your coinsurance, and then obviously your deductible as well. Now, if you're lucky enough to have some kind of employer-sponsored plan, your employer will actually take care of a portion of this monthly premium. Depending upon who you're employed with, it might be a set dollar amount, it might be a percentage. But that is one way that employers try to offer attractive benefits, is by covering a percentage of health insurance, and there might be a little bit taken out of your check before taxes are removed. So that's a little about how healthcare in general, or health insurance rather, works from a transactional standpoint. Again, from the standpoint of the insured, we're trying to transfer and reduce our risk by having an insurer be able to step in and cover certain procedures and certain types of visits that we think that we might potentially use. And then in turn, we're paying some kind of monthly premium. Along with that, we're responsible for a deductible, we have a copay, and then we potentially pay a percentage of each transaction if coinsurance is on the policy.